This Monday, we entered the bear market, and on Wednesday, the Fed announced its highest interest rate hike in almost 20 years. The further backward you can look, the further forward you can see, said Winston Churchill. According to Bert Dohmen, founder of Dohmen Capital Research, the financial conditions today are very similar to what happened in 1978. What happened back then? Fed chairman announced the Fed would not tighten money but would combat inflation through higher interest rates. And about 2 years later, T-bond prices plunged 44%. Bond yields were over 15%, hitting a 100-year high, and still most investors had devastating losses. Currently, in 2022, we see the next opportunity of a lifetime, as the financial conditions are very similar to what we saw in 1978. With interest rates now soaring, T-bond prices have already plunged 28% from their year 2020 high. Those who sold short have made great profits, while those with large bond portfolios experienced big losses this year. This is the time to be financially smart and to educate yourself. According to Dohmen, this is only the beginning. The reason for this forecast is the fact that inflation is rising and therefore interest rates are on their way higher. The central banks always try to fight inflation by hiking interest rates, as the Fed is doing right now. But Dohmen says this is wrong. Rising interest rates don't tame inflation, they worsen it. On the internet, this wrong theory is explained. As interest rates are increased, consumers tend to save because returns from savings are higher. With less disposable income being spent, the economy slows and inflation decreases. But it says nothing about consumer spending, and it is increasing because of inflation. Consumers want to beat future price increases. Rising interest rates only reduce growth when they result in tight money, in other words, the inability to get new loans. Borrowed money at today's very low interest rates is basically free, as you pay back the loans with much cheaper money that has far less purchasing power. If you borrow money at 6%, you are still way ahead of true inflation by 10 percentage points. Therefore, it pays to borrow as long as banks make the loans. This is how millionaires become billionaires. As long as banks want to lend at those low rates, this in turn boosts borrowing and thus inflation growth. In other words, the Fed isn't doing what it has to in order to fight inflation, which is simple. They have to tighten the availability of credit, and the Fed isn't doing it. Contrary, the popular opinion, rate hikes is not tightening money. In fact, the Fed doesn't sufficiently reduce its balance sheet by taking money out of the system. Then higher interest rates will actually increase inflation, as it increases the cost of doing business. Now let's get to the stock market. I think we can agree on one. The actual reason for the market sell-off is galloping inflation, it's not the war. It's important to point out that in this phase of the inflation cycle, stock sectors of inflation beneficiaries will rise very nicely, while those that suffer from inflation will plunge, as we can see in the Nasdaq. The big money will be made on the short side of the market, but that will require the most experienced guidance. This environment should continue until the Fed gets serious about fighting inflation, which they are not right now. They will not create tight money before the November 2022 midterm elections, in my opinion. Remember, rising rates doesn't mean tightening. But once the Fed does indeed start fighting inflation in a serious manner with tight money and credit, probably somewhere in 2023, everything will plunge, including precious metals. And I think this is the opportunity of a lifetime for us investors. However, the early phases of a bear market and an inflationary environment offer superb opportunities. Let me know what your opinion is about the current market situation, and I see you again with one of my next videos.